good afternoon, and good morning to a few. Our usual housekeeping items before we dive into the consumer credit trends. Our data is lagged. Originations are through April. Portfolio captures information through June 2026. Origination includes new account openings. Portfolio includes outstanding balances, utilization in the case of revolving products, and delinquency trends for all. On slides where you see arrows, the colors represent the impact to the consumer, not the lenders, green being positive and red negative. Next slide, please. As of April 2026, originations have been on the rise year over year across all products, except for private label or retail card on the far right. And it has continued to decline except for 2021 when we observed a slight increase in origination volumes, but it's been shrinking over the last 10 years now. Over 1.7 million first mortgages have been originated year to date for a total dollar amount of almost $664 billion, and that's the first from the left. This is an increase of almost 22% in the number of accounts and an even larger year-over-year increase in terms of balance at 30.7%, in part as a result of higher costs of homes. While auto and bank card have also exhibited year-to-date increases in originations, both in year-to-date dollar balances above the April inflation of 3.8%. It is personal loans, and that's the second one from the right, that continues to be the one with the greatest increase after mortgages. It has grown by 24.7 billion, and that represents an increase of 14% compared to the prior year. There's also a third product that has been showing sustained growth in the mortgage family that we will get to shortly. Next slide, please. While home equity loans and home equity lines of credit make up only approximately 12% of the overall originated mortgage balance, the HELOCs in the middle have remained almost flat in the year-over-year comparison. HELOCs, on the other hand, the originated balance, the first one from the right, has increased by 11.6% when compared to April of last year. And this, we will see in a few slides, trickles down from a continued reliance and use of the product. Next slide, please. If we take a closer look at first mortgage originations, we can observe the 2021 surge in the charts on the left in both the volume of accounts at the top and the balance, the chart at the bottom. This was the year when mortgage rates were almost the most favorable and below 3%. Things have slowed down since then, although we are observing increasing originated volumes in both balance and accounts, as I mentioned before. Over 70% of originated accounts in April were issued to super prime consumers. These are consumers with Vantage scores of 720 and above. Consumers, on the other hand, with credit risk scores less than 620, known as subprime, except for Q1 2024 when they reached 5.2% participation, and that's the chart on the right, top right. They've originated between 4.3 and less than 5% of first mortgages since the end of 2022. Individuals are priced out from rising cost of homes and the minimum income required to qualify based on, for example, the new Redfin report, and Joe mentioned it earlier. A household would need an annual income of almost $110,000 to purchase the medium-priced U.S. home in June of 2026, while spending no more than 30% on housing costs. And even with government assistance and lower down payment requirements, the current average 30-year fixed loans hover between 6.5 and 6.7 for those that qualify. Based on our credit trends data, the average loan amount for a first mortgage is over $373,000. If we evaluate now who's lending, the bottom right table, Of the over 1.7 million first mortgages originated year to date as of April of this year, mortgage companies originated over 53% of these accounts. 21% came from banks, 18% from other types of lenders, and 7.5% from credit unions. But it is these last two type of lenders that have grown the most when compared to April of last year. Next slide, please. If we look now at the portfolio metrics, the total outstanding consumer debt on the left, as of June 2026, it has grown year over year, but below the 3.5% inflation rate observed that month. And it stands at 18.2 trillion. And it has been around this since December of last year. That general cooling off is also present in the debt components, particularly the non-revolving debt, and that's the first one from the right. It has only increased by 1.2% and stands at $3.5 trillion. Recall, non-revolving debt is made up by auto loans and leases, student loans, and personal loans. The revolving debt, and that's the second one from the right, includes bank card, private label, retail cards, and other revolving products, and stands at 1.2 trillion as of June of 2026. And it has increased by 3%. And this is the largest year-over-year increase of all debt components. The mortgage debt, and that's the second one from the left, makes up 74% of the consumer debt and increased by 2.3%. It stands at 13.5 trillion and is made up by first mortgages at 12.8 trillion, and that's almost 95% of the overall mortgage share. Home equity lines of credit, 3.3% approximately, and home equity loans at less than 2%. And while the contribution of these last two products is small, the HELOC balance has increased by over 12.5% year over year and stands at almost 445 billion, and from that heavy, more active use among consumers that have access to this product. Let's look into the revolving utilization on the next slide, please. The average bank card utilization is holding steady, currently at 20.4%, and largely due to rising credit limits rather than reduced usage. That's the first chart on the left. The average has been 21% over the last 3 years, while the subprime segment has been operating in the mid-70s. In the case of the home equity lines of credit on the right, the average utilization is over 43%, and it continues to grow at a rate that mirrors the overall increase in the credit limits, which reached $1 trillion in January. Subprime utilization has been in the upper 80s for this product. We asked our customers, lenders like you, how households were using this product, and you confirmed what we have highlighted before. Individuals have pivoted from home renovations, that was the most popular purpose before, to debt consolidation and emergency or cash funds for big ticket items such as educational payments. Next slide, please. If we now look at how individuals are meeting or not their payment obligations, in the case of revolving products, the delinquency trends indicated in pink in 2026 are all tracking at or below the previous year's delinquencies, lines in yellow for 2025, in blue for 2024. HELOC on the right exhibits the lowest delinquency rate of revolving and non-revolving products that we will get to next. 90 or more days past due balance stands at 0.52% as of June. If we were to look at the 60 or more days past due metric, it's 0.7%. And only 2022 and 2023 have been better years for HELOCs from a delinquency standpoint. Next slide, please. In the case of installment products, delinquencies continue to decline on a year-over-year basis for all products as of June of 2026, except for first mortgages, although it is now showing a month-over-month improvement, declining by 3.6%. And there's also a decline in the month-over-month comparison for the unit, 90 or more days past due metric. Student loan, the second one from the right, exhibits the highest delinquency numbers of all credit products, although now reversing the 2026 upward trajectory observed through May. And as a reminder, this is based on the student loan universe of accounts that have an outstanding balance and are not in deferred status. Next slide, please. First, mortgage delinquencies for subprime consumers on the bottom left have also decreased on a month-over-month basis, but it is over 15 times the overall first mortgage delinquency. Subprime 90 or more days past due delinquency, balance delinquency, when we consider all consumers scoring less than 620, sits at 14.6% in June of 2026, while the overall mortgage dollar delinquency stands at 0.94%. The overall number of accounts 90 or more days past due delinquency stands at 0.98%. Mortgage companies posted a 1.3% in this unit metric, and that's the top right table, with the largest year-over-year increase among major lender types. Recall, mortgage companies originated over 53% of loans year-to-date in April, and at this overall portfolio level, they hold over 51% of the first mortgage outstanding debt. Credit unions maintained both the lowest unit delinquency rate of 0.3% and the lowest increase at 14.3% year over year. If we look at the unit delinquency by score band, and that's the table at the bottom, on the bottom right, deep subprime account, and this corresponds to consumers with scores less than 580, with scores less than 580, they carry the highest delinquency rate at 18.5%. And we include these and other details in our August First Mortgage Insights report, which you can access now by clicking on Resources at the bottom of your presentation screen and selecting Links.